Well, good afternoon. Happy Friday, March 18th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Well, we're into March Madness, and that does not exclude what's happening in the mortgage-backed securities market. It was not a terrific week in the world of mortgage interest rates, and really all the damage being done in the first 3 business days of the week. I'll flip the screen around here in a minute and talk you through it. As a reminder, the mortgage-backed securities chart will go over the red days or bad days. That means the value of the mortgage-backed security is declining. Interest rates are headed up. Vice versa, green days are good days. Value of the security is going up. Mortgage interest rates are going down. Everybody wants the green days, but unfortunately, we've had a lot more red days. Let me zoom in here to the past month, and we can see what's been happening in the world of mortgage-backed securities really for about the past 8 business days leading up to Wednesday's Federal Reserve rate decision. Policy statement coming out at 2 p.m. Eastern time, where the Fed announces, I'm sure you've heard, a 1/4 point increase to the Fed funds rate. Now, the Fed funds rate is an overnight lending rate to banks and financial institutions. It's not a mortgage rate. And candidly, it doesn't really directly impact mortgage interest rates. That being said, the reason for the Fed funds rate hike is the exact same reason that mortgage interest rates are worsening. So the cause is similar, but that instrument doesn't necessarily affect mortgage interest rates. And the reason, we'll get back to the reason here, the reason that all of this is happening is inflation. For a long time, inflation was running about 300% of the Fed's target rate, which is 2%. Now it's running upwards of around 400%, or right close to 400% of the Fed's target rate. And of course, the conflict in the Ukraine, humanitarian issues aside, the conflict in the Ukraine is doing nothing to help that, with the price of oil skyrocketing. And of course, you're experiencing that at the pump if you have a gas-powered car. Let's take a look, though, at the difference between the Fed funds rate and mortgage interest rates, because this is a little bit fascinating, and maybe we'll dispel some misconceptions. So a lot of people think that the Fed funds rate, which is the blue line on this graph, is directly tied to mortgage interest rates, and that's not the case. Mortgage interest rates represent this orange line. You can see a much more dynamic, much more fluid movement, day-to-day movement, whereas this is a little more choppy stair-step movement with the Fed funds rate. Now, the Fed directly controls this blue line. The Fed cannot control this orange line. That is controlled by investment in mortgage-backed securities. So you can see that at times they certainly do marry up, but at times they diverge. So it's not always the most perfect indicator of what's happening with mortgage interest rates. So important to know that. One of the other things that we're starting to keep our eye on is the potential inverted yield curve. Now, the inverted yield curve can be, and usually is, a predictor of the onset of a recession. Now, a recession, by definition, is 2 contracting quarters, consecutive contracting quarters of GDP. The Fed just cut its forecast for GDP for this year, for 2022. They made that policy announcement on Wednesday as well, or that forecast on Wednesday as well. And when we start to see the yield on the 2-year Treasury get close or eclipse the yield on the 10-year Treasury, that can be an indicator of recession. So let's take a look at where we are there. Let me scroll down the page and show you that chart. So this shows the spread between the 2s and the 10s, right? The 2-year spread versus the 10-year spread. And when this orange line dips below 0, and here it is right here at 0.2, something like that, when it dips below 0, that's when we know we have an inverted yield curve, and that can be a predictor of recession. A lot of really interesting dynamics at place in our economy right now. We have tons of job openings, not enough people in the workforce. We have the Great Resignation going on. We've talked about that on prior episodes. Of course, we've got inflation running close to 400% of the Fed's target rate. We now have a military action going on overseas. We have the Fed raising the Fed funds rate, and we have the Fed that has stopped buying mortgage-backed securities and treasuries, rightfully so, but are also going to begin to unwind their position on their trillions of dollars worth of balance sheet items. So just a whole lot of factors that are in play, and that would give you some indication as to why the market has just been so volatile here in 2022. If we go back here and we take a max look back, we can see how relatively stable things were all the way through 2021, all the way to the very end of 2021, and then this is what has started to happen in 2022. All of this really, really dynamic movement, unfortunately most of it negative dynamic movement, and that's why interest rates are where they are. They're the highest that they've been in 3 years, and that trend is not likely to reverse itself anytime soon. Of course, this is all going to be interesting to watch. We'll chart it out for you week by week as we move through the spring and into early summer. In the meantime, let's watch some basketball and have fun with March Madness. If I can be of any service to you, don't hesitate to reach out, mark.milam at highlandmtg.com. Thanks.